Section 6. Applying FPAS Mark II with ENDOCRED simulations, U.S. economy outlook and strategic policy communication. This section presents an abridged forecast exercise using ENDOCRED to produce FPAS Mark II scenarios for the U.S. economy that illustrates the current shift within the monetary policy world towards scenarios-based forward guidance. Figure 13. There is no shortage of issues in the U.S. these days that could push the future path of the Fed funds rate in different directions. These include uncertainty around the stars and bars underlying inflation, the NAIRU, and the neutral interest rate, fiscal policy, and debt sustainability, a possible bubble in asset prices, as well as new policies connected to the incoming Trump administration, namely tariffs. For the purposes of this exercise, we choose to focus on the topic of higher underlying inflation and the NAIRU, which are most related to the analysis around the nonlinear Phillips curve and endogenous policy credibility. The analytical process begins by constructing a market reference scenario based on the expected path of the Fed funds rate in financial markets, which has experienced substantial volatility in 2024. In the summer of 2024, a rise in the unemployment rate triggered fears that labor market weakness was accelerating and would soon be consistent with a recession, thus requiring deep cuts in the Fed funds rate. However, in the intervening months, recessionary fears abated as the labor market stopped weakening and the expected funds rate shifted substantially higher once again. Figure 12. The narrative of the market reference scenario could be summarized as a return to the prevailing soft landing view, where the unemployment rate stabilizes around the Fed's current view of the NAIRU, disinflation continues in sticky prices, and the real economy can absorb a higher neutral interest rate without causing a recession. We generate a market reference scenario that follows this narrative, which essentially entails setting the initial conditions of the economy and then simply letting the model to run without any shocks. The initial conditions are defined by real GDP being a bit above potential output, underlying inflation pressures are modest, the unemployment rate is near NAIRU, and credibility is perfect, hence monetary policy is restrictive, and therefore it's high time to bring the policy rate to its neutral position or risk a recession. Case A is a higher underlying inflation scenario. We apply an inflation shock to the model to reflect higher underlying inflation as seen in categories such as sticky prices, where inflation has been steadily between 3–4%. Monetary policy would need to be re-evaluated in terms of how restrictive it has been thus far as the labor market continues to outperform the Fed's estimate of the NAIRU. In the scenario, the Fed responds quickly by talking up an extended pause to further rate cuts to maintain a more restrictive policy stance into 2025 to counteract the inflationary forces and bring the labor market into better balance with its objectives. Case B is a hard landing scenario from September 2024. We apply a negative demand shock to the model, reflecting concerns that higher underlying inflation are misplaced, inflation is anchored, and monetary policy has been highly restrictive for some time. The long and variable lags of monetary policy are still filtering their way through the economy, resulting in substantial labor market slack to form an inflation briefly to undershoot the target, requiring deeper interest rate cuts to prevent a more serious recession. Case X describes a dark corner type of scenario that only differs from the Case A scenario in a subtle way, but can have serious consequences. In this scenario, the Fed delays its response to higher underlying inflation, which we tune to mimic the market reference scenario. Why would they delay their response? The most obvious candidate is a NAIRU shock mirroring the type of conditions confronted by the Fed in the 1970s. In the scenario, the near-term unemployment rate is similar to the Case A scenario, but we assume that the NAIRU is higher than what the Fed currently communicates. The higher NAIRU masks the true nature of excess demand in the economy, as it did in the 1970s. Hence, it takes time for the Fed to recognize, while sticky price and wage inflation remain more persistent than expected. We get the classic insight from ENDOCRED, where a delay in tightening of monetary policy in the short run leads to a deterioration in credibility and a more aggressive higher for longer tightening cycle than had they pursued a Case A policy stance to begin with. This presentation of scenarios should stimulate a constructive discussion among policymakers and the public on the monetary policy outlook. Are policymakers happy with the market reference scenario? Do they want to nudge the market reference scenario in a Case A or B direction? Or in a more extreme case, do they want to pursue a policy of least regrets to prevent the risk of a Case X from materializing? Suppose the Fed wants to take advantage of the relative calm in commodity prices such as food and oil and pursue a policy that is focused on ensuring credibility is achieved not only in bond markets but also among wage and price setters where there are still concerns. The Fed communicates their preferences for a higher path of the policy rate until there is clearer evidence that an inflation premium has not become embedded in the economy. This modest insurance policy would also avoid the potential deleterious effects of underestimating the Naira, which would push us closer to the nonlinear Phillips curve world. The Fed communicates that it must ensure a higher degree of confidence that the economy is anchored to its 2% target, with the additional objective of making the economy more resistant to inflationary shocks in the future.